And we are live. So this is Charlie and I's second time now being live. I'm going to try to cut through the context pretty quickly, but we just had about a 45-minute conversation, really diving into what Castle Finance is building. And at a very high level, it's DAO Treasury management on Solana. And we really just got into the nitty gritty, laid out what the ecosystem landscape currently looks like for DAOs and why the tooling is so important. So, with that being said, we're going to jump right back into it. Honestly, our conversation will probably be more refined now because it's been the second time. So, super excited to have you on, Charlie. How's it going?
Good. This we'll get a chance to have less ums and uhs and make the message a bit clearer, a short amount of time. So actually might be better for the viewer and listener now.
Perfect. We're just refining the pitch more and more. So to kick things off, we'll start it off with the context again. What are you guys building at Castle Finance? What really are the goals behind it that you're trying to achieve?
We want to enable DAOs to focus on what they do best instead of on having to learn all about financial management and treasury tools and yield farming and accounting, and really offload those things onto people and the tools that make it really easy to do the right thing by default. I was telling you earlier that there's one of my friends who's a corporate treasurer at just a regular company kind of started looking into what some of these DAOs are doing with their treasuries, with their paying the contributors, financial management. And he was saying that if he was doing practices that are pretty common in the space right now, then he would be sued for securities fraud and potentially for negligence of financial management. We have seen a lot of DAOs that potentially don't have enough money to pay their contributors in the very long term, potentially doing too risky things. And we really view that as a tooling problem, a tooling and education problem, rather than them doing it maliciously or them being stupid. It's really just too hard right now for people to do the right thing in terms of their financial management.
Definitely. And we got onto this riff that I pulled up because of these pieces of tying back to TradFi, where you guys are really looking at traditional treasury management, what big corporations are doing, the idea that a lot of treasuries are held in bonds to get something like or US treasuries to get something like a 1 to 2% return. Well, DeFi can actually make this even better returns, but there's a lot of risks to navigate, even simple things like tracking, P&L, dashboards. So you guys really look to minimize all of this. And I think the thing that's really important is protocols are obviously building a product, whether it's something like derivatives or even a game. They don't have time to go back and look at the failures of traditional treasury management and also how to take that and apply them to decentralized finance. So that's specifically the domain that you guys are really looking to dive into. So from there, I would just like to ask, how did you come across this and what really got you and your team excited about treasury management? What's your guys' background that led you to this path?
Yeah, so my co-founder Adam and I both come from tech backgrounds, where I was at Amazon and then at Workday for a while doing machine learning engineering and research. Adam used to be at Microsoft and then moved over to Commonwealth, which was building DAO governance and communication platforms for DYDX and Beanstalk, other different DAOs on Ethereum. And so he came across this problem before I did. I was much more into just straight DeFi, degen yield farming, derivatives, stuff like that. And we kind of recognized the opportunity for a lot of what we've been building out in the past few months when we started talking to a lot of the DAOs that have existed for a while and just seeing how much money they have. I mean, it's one thing when you're a startup who has $5 million on your books and that's enough runway for you for 2 years. It's pretty much okay to just keep that in a regular savings account in a wallet and just go from there. But when you're someone like some of these DAOs that have, first of all, hundreds of millions of dollars in their own governance token, and even sometimes tens of millions of dollars in stable coins. I mean, that's a lot of lost value, loss of lost opportunity cost when you're just kind of leaving it to do nothing. You can point to countless examples inside of the DeFi ecosystem. There's some insurance funds that have $100 million and they have a payroll of only $2 to $3 million, whereas getting like a 4% yield is totally doable, totally achievable goal. And so we really just view our place in the ecosystem as, like I said before, helping to both educate and then build tools for DAOs who have this huge amount of money to do the right thing. We're actually kind of impressed that and disappointed in some ways that this hasn't been done before, although it does make sense to some extent because DAOs really are just very new. And so not that many people have kind of recognized that DAOs are going to be such a big thing in the future. And we're betting really hard that one of the next $1 trillion companies will have started as a DAO. And we want to be at the forefront of helping them manage their finances.
Yeah. And this infrastructure is very much lacking, is really the big thing of the landscape. And so we touched on the nitty gritty things that you guys are looking to optimize. I think something that's even notable is trying to make the whole stack efficient, even setting up things like payroll, as well as things that you guys have been bouncing around and thinking about. So I think the most logical segue here is obviously for DAOs holding a lot of stable coins, most native users know that anywhere from 6 to 12% yield on your stable coins is something that is able to be found in DeFi ecosystems. Where are you guys specifically looking here on Solana? And I think a big thing is, how do you guys evaluate the risk? What are the different variables that you guys look at when trying to put these things together and construct something that's capital efficient, but also not putting a treasury at risk? Because it's obviously not meant to be high risk.
Yeah, it's a great question. And one that we've actively been asking our customers and potential customers. And what we've learned is that first and foremost, they really, like you said, can't lose that money. It's one thing when you're just DeFi degen slinging around 100K, and if you lose it, really, like, it hurts, but it's at the end of the day no big deal because you can get potentially EV of up to 10 to 20% for your trouble. But when you're a DAO custodying hundreds of millions of dollars on behalf of your token holders, people who have trusted you, you really can't afford to go into those high risk strategies and lose that money. So we have a very, very strong focus on risk management, where we view the number one risk as smart contract risk or team risk via being rug pulled. And so we are very, very selective with the sources of yield that we actually will go out and send money to. So some of the criteria include things like having open source projects that have an extensive security audit, and also have deploy keys of their program controlled by a multi-sig or a DAO, or at least on a route to doing that. And we really want to, and the things that even if you only have a reliance on those factors alone, there's still, of course, the risk that the odd thing happens where a bug is found and funds are drained. And so to combat that, we want to put into play concentration limits where, like, for example, we're never going to send 100% of the funds into just one single program. It's just not very safe thing to do. And while, yes, that you take a haircut in the yields that you're earning, you might, while you're only taking getting half of the return, you're maybe taking a quarter of the risk. And so that's a very acceptable trade-off for a lot of these DAOs, and one that they're very happy to make.
Yeah, I really like the case that you've made for the fact that having a protocol that is open source and then going out and incentivizing bug bounties, that it shouldn't be understated at how much, I wouldn't say value, but how much security that brings to the table, in the sense of actually incentivizing white hats is really big. Because even if the white hat can steal something like $20 million, even a $1 million bounty might be a lot more attractive just in thinking about the actual cost of having to wash the money, being a criminal, and the ethics that go into that. It definitely warrants a discount even like that. Like no one wants to do, the average person doesn't want to do something illegal. So if they're offered something that aligns incentives, even if it's not the entire amount of the hack, they are willing to take it. And I
Yeah.
think you have a really good piece of anecdotal evidence to the power of open source. You guys were obviously looking to integrate with lending protocols, and you guys would look at this open source code, start to do your own due diligence on top of the audits, on top of these things, and you actually came across a bug there. So I think that is just a really good testament to the power of that, and it seems to be discounted by a lot of protocols.
Yeah, exactly. Quite frankly, it's fucking ridiculous at how few open source projects there are in terms of TVL. I mean, if you look at the top 10 protocols, 5 of them are closed source. Not going to call them out specifically, but you can go to DeFi Llama and find them out yourselves. And to your point, yeah, we were looking at specifically Jet and just came across a bug that let them, or that could let anyone drain the $20 million that was in there. And it's exactly right. People want the legitimacy of finding a bug bounty, and it's the community does really respond to white hats that end up reporting these and getting a legitimate reward. Where, I mean, I was in a position where I had disclosed this bug, gotten a bug bounty, posted about it on Twitter, and that was by far the most popular tweet that I've ever done, and gained pretty much doubled my followers overnight, and gains the Castle brand a lot more legitimacy than it had before, and established itself as a good actor in the space. And we're talking a little bit offline about how there's definitely some more shady things that tend to go on, and I think just proving to the community that you are a good contributor and that you want to help goes a long way in terms of not only just selling to DAOs, but in the long term establishing a good reputation.
Yeah, I think it's incredibly important, even when you have people trusting you with the management of their treasury. This is something where it's not running a DeFi degen fund where you're just looking for insane upside. It's really thinking about how to analyze the risk and put it in secure places. So something that we lightly glossed over and just want to double back on is the fact that how you guys are tranching risk across multiple protocols that are all practicing safe security measures. So obviously bugs exist. It's software. This is something that from the beginning of time when developing, it's unavoidable, but being able to identify people who are prioritizing these security risks and practicing these safe measures and then tranching it across them. Again, I'm going to repeat myself, but shouldn't be understated. And it's something that has a lot of value. A piece of anecdotal evidence I threw out on my end was the fact of, even though we're not a DAO, we have USDC sitting around. And the thought is, we definitely want to earn interest on this, but where do we provide this liquidity in a place that where we're confident that smart contract risk doesn't affect us? Because again, we need this money. It is a treasury. So I think that's really important to have that ethos, have that thought of adding value to the community. Another thing that goes back to that was just talking about how you guys are looking to grow. You're not looking to collect fees in the beginning. The real issue you're trying to tackle is building a product that DAOs can use.
Yeah, and really it's not just DAOs. I mean, we actually have had a lot of questions recently of people saying, oh, so is there like, yeah, I know you're selling to DAOs, but we'd also be really interested. Like, tell us when we can use it too. And we're like, oh, we should message better, because actually anyone will be able to use it. It's not just a DAO. You just go to the website, click Connect Phantom, and be able to deposit. And so that's really on us for not having the messaging around that. We've just been hyper focused on creating the best product we can for DAOs, like the classic startup, dominate a niche and then land and expand. But really, it is usable by anyone. And our long-term play here, to leak a little bit of alpha, is we just want to be the best collateral in the space, the most money good yield earning asset in all of DeFi. And the parallel to TradFi here is most corporate treasuries will for their operational funds have different durations of US government bonds, which are, of course, the best collateral in the TradFi space. Bank wants to lend to another bank, they'll take bonds as collateral. And for us, we want to establish our LP token for our vault as the most money good yield earning collateral, where it can essentially be trusted to always be good for what it is, that it actually does hold money inside of the vault that are earning yield from the safest places.
Yeah, that's super interesting. So the question that came to my mind at the top of this that I actually did not ask any time around is, what realistically, with you guys looking at how you're analyzing the risk, looking at how to keep this money safe but keep it capital efficient, what is the general yield that you guys are ballpark aiming for that seems realistic? And then where are a lot of these places where you're looking to distribute this risk across and collect yield from?
Yeah, so we think that a good target for amount of yield we can generate is around 3 to 5%. And like I said before, there's some DAOs that have $100 million and $2 million payroll. And so that's more than enough for them to pay their payroll over the interest that they get. And so we think that the safest places in all of DeFi are the short-term repo lending markets, which are Solana, Port, and Jet. They're all open source, audited, of course. Plus lending for margin trading at places like Mango, potentially in the future options markets and derivative markets like 01, potentially Zeta as well, and also stable swaps like Saber, Mercurial, possibly Orca Whirlpools when they stand up, more concentrated liquidity stable swaps in that too. And so, like I said, targeting somewhere around 3 to 5% with a very strong focus on making it sustainable. So, of course, everyone's favorite stablecoin yield is Anchor these days, very controversial. And we don't necessarily think that those yields are going to last forever. And we would prefer to play the long game here. And from the start, only send money to places that in the future we're not going to have to remove because they just stopped giving away their own token.
Yeah. I think a big thing we were even talking about, I don't know at what point. I mean, we did this stream once already over, but the idea of it started out as the idea of being able to ship products and not necessarily overpromise and be realistic. And the fact of the matter is, being able to earn 3 to 5% and doing it in a safe manner is something that is very massive, especially when you're talking about the size of treasuries being upwards of 100 million. It really will start to make a dent in something like payroll. So just jumping around a little bit here, but this is something super interesting that we talked about a little bit, is just how obviously not all DAOs are the same. Some DAOs may be a little more keen on risk than others. What have you guys found when talking to DAOs, and how do you look to cater to these different types of DAOs?
Yeah, so broadly speaking, there's DeFi DAOs, investment DAOs, and then ones that have a product that's not in DeFi broadly. And so they all have kind of different needs in terms of how they think about risk. For example, going back to someone like, let's use some of our partners that we send money to, where if something happens, a lot of volatility, and there's a lot of liquidations that are taking place, they have part of their treasury in an insurance fund where they'll be able to backstop some of those losses and make their users whole. And that's a big part of users trusting them and why they'll deposit money into that sort of protocol. And so it's really important for them to take on much less risky strategies and to be actually aware of how the returns are correlated by what they're sourcing with the risks that they'll have to deploy it. So, for example, someone like Mango Markets is very strongly against being short volatility and earning yield through something like collecting premiums through some of these options vaults, simply because when they start to lose money in those options vaults, that's the exact same time when they're going to need the money the most. And so it just doesn't make sense for them.
Yeah.
Whereas someone like a gaming DAO, where they just need to pay their contributors and they have a very clear sense of like when those payments need to happen and everything like that, they can afford to take on a little bit more liquidity risk, a little bit more risk in general, have their capital locked up a little bit. And for a lot of them, they might say, hey, it's a winner take all market. If we don't capture value, if we don't spend money aggressively anyway, then we're going to lose out. And so we might as well take on some slightly more risky strategies in order to be able to spend more on customer acquisition and win out in the market in the long term.
Yeah. When you lay it out, it makes a lot of sense, especially for if you have a project that is just looking for runway, then they can potentially looking for runway and it's only a small portion of their treasury. They can do something a little bit more risky. But when you have something like a derivatives protocol or a DeFi protocol that potentially in the event of a black swan may need to backstop the protocol or put up capital. We've seen this in a few different instances. The last thing you want is to have mainly your governance token, which has happened. Hasi refers to it in March of 2020, where there's a black swan event. And specifically, he refers to MakerDAO, but I'm sure there are other DAOs that experience similar things where they actually had their native governance token that they were forced to liquidate to backstop their protocol. So this is just a piece of anecdotal evidence that goes to what you were touching on, Charlie, with the idea of not having assets that are correlated. So I think that's super interesting and shouldn't be discounted. It seems pretty logical when you talk and think through it, but a lot of DAOs aren't practicing this.
Yeah, there's just not enough education in the space, and it's something that we really want to try and change. We're going to start a content series on what more responsible management practices might look like and kind of how our products fit into that picture. And of course, we're biased because we made the products specifically to solve these sorts of problems. But we really do think that there'll be quite a. We really just want to be good actors in the space and educate people on like what the best practices are. And one of the ones that you spoke to is, having a large portion of the coins that you actually are denominating your payments in. So like if you're paying people in USDC or even implicitly in USDC, where you're like saying, oh, we'll give you an amount of the governance token equivalent to this, that's still like denominated in USDC. And so you really want to have that on hand to be able to pay those debts out later.
Yeah, that makes a ton of sense there. And really, I'm just trying to wrap more on the idea of the higher level, why this is so important in the sense of what we've touched on. There's currently a lot of friction. I think an example I've thrown out before is the fact that it makes a lot of sense for a treasury to be tranched across a lot of different protocols. If you can find 6 to 7 that are all high rated in the realms of having good smart contract security, it's probably a decent idea to be able to contribute a bit between them because you never really know where a bug will be. So having it spread across 7 protocols, if one has a bug, then 6/7 of the treasury is still okay. It's safe. But for someone actually in a DAO to go do this all manually, especially considering that P&L isn't tracked, it doesn't really make sense. And then on top of that, something we touched on is just the fact that DeFi is great, but a lot of these things are important to understand why things work the way they do in TradFi. So one, you can improve on it, but not make the same mistakes. Something we were talking about is a lot of people may be just keen to jump in and build TradFi or DeFi products without looking at what has and hasn't worked in the past. And I think it's a bit naive to just think that similar mistakes won't happen in DeFi just because there's this whole ethos of Web3 and decentralized finance. So really looping it all, I think it's interesting how you guys are optimistic on what this can do, but also being realistic, understanding the problems that exist. People aren't going to be able to get 15% yield on a safe portfolio or a safe treasury. So really laying that out and having that all there is super interesting. And the fact that DAOs just don't have the time to do all of this when they're so focused on their verticals.
Exactly. And in general, I think that a lot of DeFi teams could learn from the approaches of normal Web 2 startups, where it's like you have a target user, a target market, and you learn what their problems are and actually build custom solutions for them and work very closely with them. Where it feels today like a lot of DeFi projects just kind of assume that if they copy something over that was successful in TradFi or successful on another chain, that'll just automatically bring success to them as well.
Yeah.
Whereas we've really taken the approach of, going directly to DAOs, asking them what their needs are, and then trying to build things that they will actually use, actually find that it helps them achieve their missions. Because if you look in, of course, there's always going to be product market fit when you're giving away free money via liquidity mining, but that doesn't actually mean that you're going to be able to sustain that level of success after you run out of those rewards that you're just giving out. If you look in traditional finance, you see that 60 to 80% of revenue is generated by institutional corporate clients. And then you look in DeFi and it's just all targeting degens and other retail users who are just playing the how can I get the highest APY possible game. And of course, when you're giving away free money, people are always going to flock to that. And we think there's a lot of white space in serving the ever growing market of DAOs and other crypto companies that have money on chain and want to be able to use it, and not only use it to yield farm like in someone like us, but also to just manage their own protocol, generate value for their token holders in perpetuity.
Yeah. A big thing that just comes to my mind is the idea that you guys are really honed in and focused on a sustainable part of the ecosystem, really looking to how do we build this robust, something that's lasting and can be sustainable. And inherently part of that is just building in the realm of treasuries. But I think it's massively discounted from what a lot of people are doing in DeFi, really just trying to spin up whatever can get the highest yield and really just pumping out token incentives. There's been a joke that I was just like talking about with people here where it's like Web3 speculators exist, people who are willing to really jump in and use these protocols for yield, but Web3 users don't really exist. And I think you can see that in a lot of games. And when you don't have yield incentives, it's a lot harder to get these users. So I think it's super interesting and unique where let's focus on the sustainable part of the ecosystem, building out these tools that can be robust around for a while. So where I would take this from here, and I kind of want to start to wrap this up. I know we have a hard stop coming up, but I think we jumped around a lot because we had context of what we were talking about, but just a really high level idea of the tooling that Castle is bringing and the fact of the matter that this treasury management is very nascent on Solana currently. So there's a lot of work to do, from properly analyzing the risk, doing due diligence on some of these smart contracts, and then even building out a complete suite of products, right? So a dashboard where you can track P&L and see these things transparently. Also understanding that it does kind of model a corporate bank account where maybe these projects also want payments incorporated as well. So I think the big thing is not discounting what has gone well in TradFi, but then applying it to DAOs. And that's not something that DAOs are able to do, which is specifically where you guys have came in. And I think you coined it as being able to capitalize on these low-hanging fruit.
Yeah, and it really feels like there's just so much going on in the space, and there's so many people building, so many new projects. But then you actually look at really what the DAO tooling landscape kind of looks like. There's a SPL governance developer call every week, and probably there's only less than 10 developers who are active on that call, and maybe like 40 that are really listening in. So it really is a small group of people. And to your point about it being a very nascent space. And so it's really exciting to be able to be at the very forefront of what's happening, build it up from scratch, being able to not have an ecosystem like Ethereum where all credit to it. It was one of the first, but it resulted in lots of fractured products and user attention being in much different places. Whereas in Solana, we have a chance to kind of unify on common solutions and be able to integrate with almost every single person and every single team that's relevant in the space, and really try and entrench ourselves as a leading provider.
Definitely. And really, to just wrap this up, I think the big question I now have is, where is Castle looking down the line in the future? So we can talk a little bit about short term, like what's coming up, where are you guys at with that, the processes, but really, what are you excited to get gung-ho and really start building once you guys get this first MVP to mainnet? Where are you looking down the line more, 1 to 5 years?
Yeah, we are in the very short term going to be launching to a private beta to our launch partners, design partners in the next week. And we'll be going more public with how that's working out, how DAOs are liking the product, as well as having a series of educational content on exactly what it looks like to use us and what we've learned from all of our research in the space. And then in the very long term, start to afterwards, of course, add on more features, make the strategy more sustainable, add more capacity, all of that, more yield. But then looking way farther down the line than that, we really view our mandate as a company as anything that a DAO would need in order to manage their finances. So, of course, there's other companies like Zebek, MeanFi, Streamflow, all these payments, payroll companies that kind of are already entrenched in their own niches, and we really don't want to compete against them because they are doing really great work. And so we'll just see exactly what tends to crop up in the ecosystem. Of course, we're already connected with a lot of these DAOs, and we're hearing every day new problems that come up. And it's really a matter of just consolidating those learnings and trying to build products that people actually want.
Yeah. And I think it's super exciting, the unique opportunities that Web3 DeFi presents, where people are able to leverage and really compose on top of things. You can focus on your vertical and really drill that vertical in, and then be able to leverage other people that are doing the same thing in other spaces. And that's the same thing that's going on for these DAOs as well. You guys are drilling so far down into treasury management so they can drill down into things like derivatives markets, or building a game that actually is fun and can onboard this billion users to Web3. So super interesting. And I think one of the big takeaways, it's just such a nascent vertical, but there's a ton of untapped potential. And it just seems like Castle is really jumping on this and realizing it. So I'm going to wrap this all up here. This is definitely not the last that we'll be hearing from Castle and Charlie. I just want to say that I hope everyone had just as a good time as me. I pretty much have probably had this conversation 3 times now. I've had to ask Charlie. The first time we met, he obviously had this boilerplate. We had the conversation. We just did the stream, and now it's the 3rd time. And honestly, this 3rd one was the most seamless, the most fun. So hope everyone enjoyed it as well. And just want to thank you for coming on, Charlie, and working through all these technical difficulties. It's been great.
Yeah, thank you, Greg. It's not everyone always does their research as much as you do. So just wanted to commend you for that.
Awesome. And until next time, everybody, peace out, and keep an eye out for developments coming out of Castle.